We don't think oil prices have much upside from current levels till at least the end of this year. We do think they can recover to around $50, $55 for Brent crude, about the low 50s for WTI. Next year, however, does get interesting because the low oil price environment for 2 years by then will be starting to impact on supplies. We are already starting to see significant reductions in CapEx, capital expenditure programs by companies, which will mean lower supplies going forward. So by the end of next year, we could be in $70 crude oil environment again. The main driving force behind higher oil prices in the future, particularly late 2016 and early 2017, is the drop in supplies. At the moment, we've seen oil prices being around $50 for about 12 months. However, it always takes longer than that for oil companies to take decisions, long-term decisions on projects. They've started to defer and cancel projects. We've identified 5 million barrels per day of projects that have been cancelled or been deferred between 2017 and 2019. That is obviously going to create a huge shortfall in the market. In the near term, US supplies are actually starting to fall very rapidly because shale producers whose finances are also a bit of a problem because they are highly indebted. Oil prices are down by 50%. So they have started to scale back their output. Production has already fallen by something like 600,000 barrels per day from the peak in April till now. We think that can continue for the next 6 months before stabilizing a little. The main risk to our forecasts is costs. The reason I say this is because obviously as prices have come off, costs have fallen as well. But we view the reduction in costs as mostly to do with the fall in activity, i.e. it's cyclical. Once oil prices recover, activity picks up again, costs will go up again, is our view. However, if it turns out to be that the reduction in costs is structural, there has been some huge technological innovation in between, and then yes, prices go back up to the 70s and costs haven't gone back up again, then yes, there will be a lower average price in the longer term. We will probably not need $90 again to incentivize marginal production in Canada or in the deep water. We could probably do it at $70. I think price volatility is here to stay, particularly with OPEC deciding not to cut output. There are huge amounts of risks with $50 or $40 oil for production in the future. We've talked about non-OPEC production being down or falling from here on. Even OPEC's own output is at risk. Iraq is cutting back production. Nigeria, Angola all have problems. So if you are likely to see a lot more volatility, then yes, risk management is extremely important. Obviously, from consumers' point of view, hedging at low prices is something that's desirable. Also because we do think oil prices are going to rise in the coming years. From a producer's point of view, of course, they would want to wait till about 2017. But generally, we do believe we are going to be in a very volatile environment. So yes, risk management is of paramount importance.